Hi, my name is Gil Malik. Welcome to Business Valuation Insights. I work with Eric Jordan as a Five Senses inspection report specialist. Today, we're diving into the concept of fair market value and exploring why experience in running a business is essential for accurate valuations. We have Eric Jordan, CPPA, and founder of the 25 Factors Affecting Business Valuation methodology. Eric, welcome.
Thanks, Gil. I'm excited to clarify what fair market value truly means and share why hands-on experience is so valuable in determining it. To start, I'm going to give you three prime examples of why hands-on experience is necessary. 1. Pilots. No airline would certify a pilot based solely on classroom and simulator training without extensive real-world flying experience. 2. Surgeons. No hospital would allow a doctor to perform surgeries based solely on theoretical knowledge without years of hands-on surgical training. 3. Art restorers. No family would entrust a valuable heirloom to someone without substantial experience in art restoration. A private business is no different to a family heirloom. You would not have an art professor restore your heirloom because they don't have 10 or 20 years of hands-on relevant experience. Theory is not enough. Someone who has owned a relevant business for 10 or 20 years has the right experience to identify and interpret the intangible assets they have had to deal with in their own business when they had skin in the game. An accounting-based valuator who has never had skin in the game by owning and operating a relevant business will rely on classroom experience and repeat the same mistakes over and over. And that is not the experience you want. That person should not be flying a passenger jet, doing surgery, or valuing a private business. A business valuation is a business valuation and not an accounting exercise. Relevant experience is key.
Eric, to start, could you define fair market value for our listeners? What are the key elements?
Certainly. Fair market value, or FMV, is defined in Canadian law as the highest price obtainable in an open, unrestricted market where both buyer and seller have reasonable knowledge of the facts, act in their own best interests, and aren't under any compulsion. Both parties must act at arm's length, with the transaction value expressed in monetary terms. This framework forms the foundation of compliance in business valuation. This is much the same in the US, UK, and Australia.
Interesting. Could you elaborate on what's meant by no compulsion to act and why that's crucial?
Absolutely. No compulsion to act ensures that neither party is forced by factors like debt, divorce, or illness to close a deal hastily. Compulsory sales affect pricing, and if these factors aren't disclosed, the valuation data is unreliable. Many traditional valuation methods ignore this, which leads to non-compliant results. I believe a good lawyer could easily challenge these valuations that use comparable sale prices and claim it is the market approach. This information is never verified in private sales.
Eric, how does Canadian law support the concept of fair market value?
Fair market value is rooted in multiple sections of Canadian law, from the Income Tax Act to the Excise Tax Act. Each of these definitions aligns with our discussion, emphasizing an open market, knowledgeable parties, and no compulsion. The Canada Revenue Agency and the Canadian Institute of Chartered Accountants provide additional guidance on FMV, especially for valuing intangible assets.
So FMV isn't just a guideline, it's embedded in law?
Exactly, Gil. It's legally defined to ensure compliance and consistency across valuations. Our approach aligns with these legal standards, especially as it relates to both tangible and intangible assets. We have a big link on our pin.ca website, and it says, "See where my valuations are entrenched in Canadian and international law and why they are not easily dismissed." Click here.
Eric, we often hear about intangible assets. How have they become such a dominant factor in FMV?
Great question. Over the last 4 decades, intangible assets have risen dramatically, from just 17% of corporate market value in 1975 to over 90% today. Studies from Ocean Tomo and the Brookings Institution highlight this shift. Assets like brand equity, intellectual property, and customer relationships now comprise the majority of a company's value, and FMV needs to reflect that.
Why are intangible assets so challenging to value, and how does your methodology address that?
Intangibles don't show up in the balance sheet, making them harder to quantify. Many accumulate value over time, and that doesn't show either. However, the 25 Factors Affecting Business Valuation methodology addresses this by factoring in the relevant factors. These factors capture the real value intangible assets bring to a business. Tangible assets are worth more when surrounded by intangible assets in an operating business.
Eric, let's talk about your methodology. How does it integrate fair market value principles?
Our 25 factors approach looks at a comprehensive range of valuation elements, ensuring a fair market assessment. It reduces subjective bias by providing a structured framework, promoting consistent and defensible valuations. We emphasize both the legal aspects of FMV and the practical insights gained from experience, making it unique in capturing a business's true value. Additionally, we use 5 senses inspection report specialists like yourself to confirm everything and to give us an estimated percentage of usefulness left in equipment and leasehold improvements and other tangible assets. This makes for a highly defendable valuation report.
So, your methodology brings together experience, legal standards, intangible assets, and where possible, a 5 senses inspection report?
Exactly. This combination makes our approach resilient and compliant. It's about seeing value in terms of the business's overall contributions, financial and intangible, while staying aligned with legal definitions.
Eric, recent laws like the Personal Property Security Act have recognized intangibles in new ways. Can you share more?
Yes, the PPSA's inclusion of intangible assets in provinces like BC and Ontario allows these assets to be used as collateral, opening up credit and financing options. This is a significant advancement as it underscores the legal importance of intangible assets and further legitimizes their role in FMV. For business owners, this means they can now leverage these assets more effectively.
Eric, this has been incredibly insightful. Fair market value is clearly more complex than many realize, especially with intangibles and experience playing such large roles. Any final thoughts for our listeners?
Thank you, Gil. Yes, I would emphasize that fair market value is about understanding both the tangible and intangible aspects of a business. It's a holistic process, and experienced insights are invaluable in making valuations compliant, accurate, and reflective of true worth. For any business owners out there, if you're thinking about valuation, make sure you're looking at the full picture and aligning with fair market principles. This is especially important if you are seeking a loan. We work closely with the Canada Small Business Financing Program, so whatever the purpose for a valuation or business appraisal, we can help.
Fantastic advice. If you're interested in learning more or need a valuation, reach out to Eric at pin.ca@gmail.com. Thanks again for joining us, Eric.